Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with a new guest on the show, Lawrence Lepard, gold stock fund manager, also investment manager at Equity Management Associates LLC. Now, Lawrence, I've followed your work for quite a while, so I'm really quite excited to have you on the show to discuss kind of macro themes when it comes to the more precious metal stock sector. And we might even get into a couple stocks here, but overall, I'm going to be having you on the show on a more regular basis. So it'll give us time to dive into a lot of the other concepts that I think some precious metal stock investors are really struggling with right here. More on a macro, big picture front. Look, we've had gold hanging up very close to all-time highs. Silver is largely traded in a range. It's nowhere close to its all-time highs, but still at a decent price for some producers to make money. However, valuations down into the stocks are crappy. Let's just be honest about it. Both large and small companies continue to struggle. A lot are way off of their all-time highs. Lawrence, you've been in this sector for a while. Have you ever seen it this bad for the stocks?
Corey, I really haven't. First of all, let me thank you for having me on your show. I know it's a great show and you got a great audience and a lot of reach. But to answer your question, no. Well, yes and no. I got full time into gold stock investing. I've kind of been interested in it for 30 years, but I really picked up the tempo in 2008 because the global financial crisis informed me that the governments were going to print a ton of money and we had a real inflationary world coming to us over time. And that was when I kind of pivoted. Before that, I'd actually been a venture capitalist and had been an investor in technology companies for 25, almost 30 years, and including the internet and stuff. So I started following PMs really and PM mining companies really heavily in '08. Okay. Had a couple good years, then obviously got my teeth kicked in from 11 to 15. And this kind of reminds me of 15. I mean, it was pretty much this dead in 15, pretty despondent. Everyone had pretty much given up, et cetera. As you recall, gold had gone from a $1,900 high in 2011 to a 1,050-ish low in 2015, and the stocks were left for dead. The sentiment was terrible. The multiples were low. It was similar to today, but I'd say this even feels a little bit worse because we're fundamentally still in a bull market. I mean, that happened in the case of a real bear market for gold. Gold had gone down from 1900 to 1,000. I mean, here we're still kind of in a bull market for gold. I mean, gold, as you point out, is only about 5% away from its all-time high. It's at 1950-ish roughly today, and these companies many of the companies make decent money at this level, and yet the stocks just trade like death. I mean, it's been a real apocalypse, and as we talked about pre-show, there's some reasons for that, but it's been very hard for all of us, to kind of keep the faith in the sector, and yet I also know from experience and having been an investor my whole career that sometimes when things look this dark, that's the best opportunity in the sense. I mean, it kind of looked this way for the oil guys back in the 2016-17 timeframe, and then oil really caught a bid and they went on a tear. And so I feel like that's what's coming to us, but it's not quite here yet, and so it's been pretty tough.
Yeah, Lawrence, you said it. I mean, it's interesting the disconnect between the period you mentioned coming out of the great financial crisis, which is also when I got interested in the sector, and the mania that we saw from 2009 to 2011 in the precious metals when people were watching what the central banks were doing, watching weakness in the financial sector. If you compare that to now, there still are some concerns about the financial sector and commercial real estate, how that may affect financial institutions. But as you mentioned, the gold price is doing a lot better than the mining shares valuations are. Let's dig into why you think that's the case, because the average cost right now for producers is about $1,350 on the AISC, the all-in sustaining cost. $1,950 gold, they're making $600 margins, but these companies are being priced like they're going to fail. And when you look at development companies, same thing, the ounces in the ground are just not getting the value. Why do you think there's such a huge disconnect between where the price of the metals are and where these mining stocks are being valued?
Yeah, it's a great question and something I think about every day. And I'll tell you my theory, and I'm not sure it's correct, but it's my theory. I think the metals are holding up pretty well because I think gold in particular, and silver not as much, is really good at looking around the corner and knowing what's coming next. And we all know that Jay Powell has been very tight since early 2022, and they had enormous. I mean, COVID created enormous growth in money supply. We've slowed it way down, and yet gold and interest rates have gone from 25 basis points to 5.25. I mean, that in general, historically looking back, that kind of an increase in the real rate of interest would have just crushed gold. And yet gold has hung in there in the mid to high 1950s. And why is that? I think the reason that is the case is that the gold investors are smart enough and they look around the corner and they know that these Federal Reserve policies cannot continue, and that the Fed will have to turn the printer back on. They will have to pivot. They've done it every time in the past. We saw they did it just recently in March with Silicon Valley Bank. They did a mini pivot. And so gold smells that it's coming. And that's why gold is held in there, in my opinion. The stocks, on the other hand, are kind of a different kettle of fish. They're more risk oriented. And I think that people who are looking at the stocks are much more thinking to themselves, okay, I know the costs for all these companies are going up. I mean, you're right, ASICs maybe are running at 1,300 an ounce, but as recently as a few years ago, they were running at 1,000. So that's a 30% increase in a couple of years. And all the costs and inputs are going up. And then if you go to, the stock, kind of the Bloomberg terminal, and you look at what the consensus estimate is for gold 5 years out, it's 1,750. Well, if you're okay, so you're a stock investor, you're building a model. If your costs are going to continue to go up from 1,300 and your selling price is going to be 1,750 in 5 years, that's a shitty business. So you don't want to own that stock. Now, I don't think there's any chance that gold's going to be at 1,750 in 5 years. I think gold will be at 3,000 or 6,000. But whatever it is, I mean, and that would be a very good business. But right now, that's not what the market is saying. And as we talked about also before the show, I mean, the market in general, I believe, still is somewhat inclined to, I mean, the gold market doesn't believe it because gold investors are sophisticated and big money and they think long term. But the general stock investors, I think, kind of believe the Fed is going to have a smooth landing of the airplane. We're going to go back to a deflationary world like we had for the past 40 years. Inflation's not going to really be a problem. You're not going to really need gold. Therefore, you're not going to really need gold stocks. So to me, that's why we have the disconnect right now. The buyer of gold is a foreign central bank that can see that the U.S. is fundamentally bankrupt and getting more bankrupt by the day. Or the buyer of gold is a very, very wealthy, savvy individual who says, I want to protect my wealth multi-generationally, and I know that they can't print this shit. And it may not be going up today, but I don't care. I'm not buying this for 6 months or a year. I'm buying this for 10 or 20 years. And so, gold is as cheap in monetary terms as it's ever been. It's as cheap as it was in 1971. It's as cheap as it was in 2000. And in both of those cases, in 71, it did a 22 bagger. That's a little exaggerated because the $35 reference price was a manipulated, Bretton Woods set price. But, from 2000, when it was at 250, it went to 1950 or 1900-ish in 2011. So it's a 7-bagger. And the same, if you look at any charts and you look at the analysis of the amount of money outstanding as against the amount of gold ounces that we have, that it's just as cheap as it was. I mean, I often point out to people that there was a time, it's quaint, but you can go back and you can say, pre-Nixon abandoning the gold standard in 71, you could take a monetary aggregate like, the equivalent of M2, and you could divide it by the 261 million ounces that the United States owns or theoretically owns, and some say they don't. And you come up with $35 an ounce. I mean, in other words, the money was covered by the gold that we held. If you did that same, just to show you how much money has been printed, Corey, if you did that same calculation today to make those sides balance, gold would have to be $80,000 an ounce. And of course, it's 1950. So the point is there's been a lot of money printed. And the reason the gold price hasn't gone up is because with paper gold and other derivatives, they've been very, very good at suppressing it. But it's like a balloon that's been held underwater, in my opinion. And that suppression, will have to come to an end. I mean, most market rigs ultimately fail. I mean, the London gold pool in the 60s, if you Google it, it's an interesting story. All the deficits of the 60s were what led to Nixon breaking the standard in 71. And that London gold pool, they were trying to hold that reference price at $35. They couldn't do it. And eventually they had to abandon, all the central banks were trying to hold it there. They couldn't do it. And eventually they had to abandon it. And I think that's what's going to happen here too. Gold's going to get through 2,100, 2,200. It's going to squirt up to 3,000. And then it's going to be game on because, to me, what drives all of that is kind of the common knowledge game of everybody coming to realize that the U.S. is bankrupt and that there is no way mathematically there is no way for the U.S. to keep its sovereign debt market healthy without printing. And that, of course, is a different issue, which is inflation. But the notion that they can, they can't make these bonds money good with interest rates. They just can't. They're going to drive the whole thing right into the ground because the interest expense is going to become too high. And it's a doom loop. As the interest expense gets higher, the deficits get bigger, et cetera. So, it's coming. But, for those of us who are in it, it's like so many financial things. Just because it's certain doesn't mean it's going to happen imminently.
So. That's a good point there, Lawrence. But let's get into the stocks a little bit more because, again, it's across the board that the stocks are struggling. And a lot of people are saying, well, the majors, the mid-tiers, they need to start taking over some of these juniors. But the deals that we're seeing done for the juniors, for the development plays, haven't been exciting. So where does that investment demand need to come from in your eyes, whether it's inside the gold sector or outside, to actually light a fire and get these stocks moving?
Well, I think that what needs to happen is, one thing that needs to happen is the U.S. stock market needs to tank because it kind of competes for capital. And as long as people think that's a good place to be, because it's been a good place to be for the last 20 years, the capital's over there. It's not with us. So we need that thing to tank a little bit. But moving back to the gold stocks themselves, they represent stunning value, and eventually that value will be recognized. What I call the sweet spot are the mid-tier to major companies that have serious profitability, serious cash flow, good projects on the books, the ability to over time grow their production, and they're trading at low multiple. They don't need additional financing, and over time, they will re-rate at much higher multiples. I've got big good companies that sometimes trade at 2, 3, 4 times cash flow, and that a cash flow yield of 50% or even 25%. That's just absurd. It's absurdly cheap. So that there'll be a re-rating that'll happen in the big producers first. As we talked pre-show, the big producers, if they were smart, and some are and some aren't, but if they were smart, they would be out using their paper to try to buy the juniors, because the juniors have all just been left around for dead. And, when you're looking at gold stocks, it's very important, in my view, you put them in two buckets. Are they generating cash and they don't need more capital to keep going? That's a good bucket. That's a very good and safe bucket. Obviously, if prices of metal fall, that could change. But assuming today's price, are they generating cash? All right, that's a positive. And then there's everything else, a development story, a drill story, whatever it might be. And those companies have to sell shares to dilute themselves to keep going. Some of them they've spent millions and millions of dollars. They've developed huge deposits. They've done a ton of work. They've got mines ready to go, or in some cases halfway built, and they're trading for pennies on the dollar. If I were a corp dev guy at a big mining company, I'd be out there picking up these little guys because you can do it in an NAV accretive way. A lot of the bigger companies are selling at 0.8 to 1.1 times NAV. And I've got all kinds of developers and small companies that are selling at fractions of NAV, 10%, 20%, 30% of NAV. So yeah, there will be a wave of consolidation. As we also talked pre-show, one of the negatives of that consolidation from those of us who are investors in these small companies is, sadly, a lot of our fellow shareholders are willing to sell out for a 30% premium. And, when you've got a good small company that is a 5-bagger over time, and an offer comes in and it gives you 20% upside or 30% upside, I don't want to take it. I want a much bigger upside in order to be enticed to sell. But sadly, a lot of companies do take it because they maybe, in some cases, don't have any other choice, or they're not necessarily always looking out for the shareholders' best interest.
Yeah, Lawrence, it's an interesting dynamic right now because it's really a story of the haves and the have-nots. There's companies that are cashed up and they can continue to do work programs, or they're a revenue-generating company, and then there's all the other companies that have their hand out looking for more capital to keep funding the operation. So it is a time where larger companies could be more predatory and scoop up some deals. But I've watched you for years in interviews and on panels discuss how you hold those two buckets, the producers that are generating revenue, maybe some of the royalty companies, and then the other bucket of the developers and explorers. Let's dig into that a little bit more as far as people listening, how they should consider their portfolio construction, because I see a lot of people, Lawrence, that get into the space and they immediately jump into the riskiest element of it, the drill plays, the furthest down the food chain, the ones that are trying to make a new discovery, but they don't have an allocation to producers or royalty companies or revenue generating companies. So between those two buckets that you outlined, how would you recommend a lot of people enter the space if they're new or just looking at it?
The first thing I would say is in general, this is a really tough space. It's kind of like, don't try this at home. But having said that, I'll offer my views on it. Because it's a tough business. I mean, this is, you're trying to find minerals, you're trying to break rocks, trying to produce rocks, and it's like Murphy's Law applies at every stage of the whole damn thing. But as Buffett said with investing, the first rule is don't lose money, and the second rule is don't, forget rule one. They are all asymmetric, and people are very often tempted to go for the drill stories because they hear about the big winners, and they think the drill stories are sexy. The problem is that a lot of times once the drill stories do that big pop, a lot of the juice is gone. I mean, I was in Snowline as an example, and we had a nice ride on it, but I'm not in it anymore because I don't think it represents as good a risk reward here. Not to say it's not a good company, but just that, when you made 10x and, it's now more fully valued compared to what it is. But in my particular case, what we try to do, I'm looking for growth at a reasonable price, and I'm looking for multiple expansion. And I think the sweet spot is a company that has production but can add more production. And what that allows you to do is make money three ways, right? If you're producing more ounces and making a profit on each ounce, okay, your profit goes up. If the price of the metal goes up, and your costs don't go up commensurately, okay, your profit goes up. And then if your multiple expands because, maybe when you're a small company and you have a couple $100 million market cap, you don't get picked up by GDXJ. But once you become a bigger company and you have a $500 million market cap, you do get added to GDXJ. Your multiple goes up. And if you add all three of those together, that can be a pretty nice ride, right? I mean, higher metal price, more profit, more production, more profit, multiple expansion, more profit. And that's why when you get it right, you can make 5 or 10 extra money. I would advise most people who don't know the space to stick with profitable producers and just skip the drill stories and the development stories. If you don't know what you're doing, your odds of getting it right consistently in the drill and development story area are pretty low. I mean, if you want to take a little bit of mad money and say, okay, I'm going to gamble on this one or gamble on that one, fine. But, having watched it now since 2008, I can assure you that most shit doesn't work. Or I shouldn't say most shit. On the drill story side, for every Snowline, there are 100 companies that are dog shit. It's important to kind of understand what you're looking at and what the risk reward is and what you're paying for it. And, there's nothing certain. It's all just probabilities. But I see people go into the space and, I mean, you at least want to have a fair bet. I mean, if you have a fair bet, you can lose. But if you consistently take a bunch of fair bets, eventually one of them, the odds are going to work and you're going to get paid. And the 10x you make on the two that work is going to make up for the two that you did that were zeros. So, and that's kind of the way you got to look at it.
Okay, so if you're focused on the producing companies, those that are cash flowing, look, it's still not an easy game, even when you do get into production early on. What are some of the obvious traps that you try to avoid for those people saying, oh, I need to be buying producers, but not every producer is equal?
Well, that's right. I mean, it's really an art, not a science. I mean, obviously it's the management team and what they've done in the past. It's the jurisdiction. I mean, there's certain areas I won't touch or, don't want to go into. It's the nature of the deposit. And it's also just kind of the valuation as against what they've got. I mean, this industry is like every other industry in that people fall in love with certain names. And they just, if you just run the simple math, you recognize that, okay, yeah, it's probably a good company, but boy, it's priced to fully reflect it. And they're going to have to really be a perfect company for that to be as good a bet as maybe some other companies. So, it's hard to say. I mean, it's an art. It's not a science. And probably if I had one thing to point to, and this is very hard for an outsider, which is why I don't, recommend. I recommend people, either buy indices or follow really good people that know what they're doing. It's, you want to make sure you've got a good management team. And even a good management team can screw it up, but at least you have a shot with a good management team. The other thing I would say I think is an interesting strategy is you want to know the story on all of these companies. And one way we've made a fair amount of money is that, the companies, they do trade schizophrenically, right? When they get some good news, they go berserk, and we typically sell into that. And then they get a piece of bad news, sometimes not even that bad of news, and they get totally annihilated. And so to me, there's alpha and returns to be generated if you really understand what the asset is. And, we've had things blow up, but the fundamentals are still okay. They're still there. I'll give you an example in a second. And, they're a good buy, right? I mean, it's like, okay, yeah, this is bad news. What happened here is bad. It sucks. But guess what? You've now, the stock's down 60%, but you know what? The metal is still there in the ground, and the new management team knows what they're going to do, and they're going to fix it. The primary example of this, one of our big holdings, and I unabashedly support it just because I know the guy who runs it and I really trust him and believe in him, is Argonaut. Richard Young, who built Teranga. Argonaut fucked up. They built a mine. They had cost overruns, etc. We all know it. The stock got destroyed. I owned it. Going down, but I really own it now because they're in the process of fixing it, and it's cheap, and it's a good deposit, and he's a good manager. So, there are situations you can find that are kind of exceptional, outside of the norm that, to my way of seeing it, represent above average risk reward.
Yeah, Lawrence, using that volatility to your advantage in the sector when you know what an asset's worth, and when it gets oversold, scooping it up, and when it gets overvalued, maybe lightening up. What about the differential between gold, silver, and let's just say copper? Those are three of the most popular mining stock areas and buckets in the business. Which one do you favor? Do you like having silver and copper too, or do you like just focusing on the gold?
Let me address that. Look, copper is probably great. We need a lot of copper. It takes forever to develop a copper mine. If we're gonna do all the stuff we're gonna do electronically, copper's important. I don't own any copper stocks. Okay, and the reason I don't is it's hard enough to stay on top of gold and silver, and they're the monetary metals in my view, much less staying on top of kind of a commodity metal that's used in a lot of industries. So I can't comment on copper. I'm not helpful there. With respect to gold and silver, I mean, as we all know, silver is kind of the schizophrenic, brother or sister of gold that goes up and down more than gold. It runs harder and it crashes harder too. And we have a pretty heavy weighting in silver, and I'm very much a silver bull. It's got a dual role. It's a monetary metal, but it's also an industrial metal, and there's and it gets used up, and so there's not a big stockpile of it out there. And as a result, if we get a shortage in silver, the price is going to zoom. And it's being used in photovoltaic cells. I've seen some studies that suggest, I'm not sure I totally believe them, that the photovoltaic stuff could consume half the silver production within the next 5 to 10 years. And if that's the case, I think right now it's kind of in the single mid-teens, of the silver production goes into solar. So that's a good thing. So we have silver mines and we have gold mines. They're both good. I mean, it's as when we're in a bull market, I mean, it would be, it wouldn't be unheard of for gold to go, say, from the 2,000 it's at now to 4,000 in the next 3 years. I think that's possible. And so that's a double. I think in the same time frame, it wouldn't, I would fully expect silver to go from 22 to 100. So that's a 5x. So it tends to be a more volatile, it's a smaller market. It's a just-in-time market. There aren't huge silver stockpiles laying around. We mine it and we use it. So, we have, I'd say probably if you look at our companies and our portfolio, we're probably about 60% gold mining and 40% silver mining. But it's interesting. It's mixed now too, because there aren't that many pure play silver miners. I mean, almost every mining company now has a little bit of both. And the question is just at what weight.
All right, Lawrence, before I get you out of here, because it is your first time on the show, can you just give our listeners some insight on how they can follow along with you and learn a little bit more about Equity Management Associates, please?
You can find me on Twitter. I tweet a lot about central banks, monetary debasement, et cetera, and this whole theme. I'm a very big advocate of sound money, so I'm just under my name on Twitter. And then I have a website, ema2.com, which talks about my fund. Fund's a private fund. We're not always open. We happen to be open right now because some people have left because they've discussed it with the space. I totally understand that. And if you've got 200,000 US, you can join the fund. That the reason that's that big is because of the SEC rules. But we manage a fund that picks these stocks professionally. I have a partner, and we've been doing it for a while. And in up markets, we have meaningfully beat the GDXJ. In down markets, we do a little worse. We're pretty aggressive. So
All right, Lawrence, great having you on the show. Thank you very much for taking some time out of your day to share your thoughts on the precious metals markets and the stocks. As I mentioned on the onset, I'm going to be having you back on approximately every month. So everyone listening, keep in touch with us. Let us know what topics you want to hear us talk to Lawrence about, and also any stocks you want us to dive into, and we will see just how granular we can get there. But hey, Lawrence, really appreciate your time. Really appreciate your